Hello, it's Jonathan Wellham of ROCKLINC Investment Partners, and it's February the 3rd, 2014. Today I want to just do a brief update on currency moves, and in particular just talk about the Canadian dollar move over the last month and over the last year and how that's impacted our portfolios and how we're positioning going forward. Before I do that, I just want to note some of the changes that have been going on in the markets over the last month and over the last year. There's been some fairly significant swings, and I just want to again just give you a couple of those highlights for you, and then we'll get back to the currency issue. Over the last month, the month of January, the TSX was one of the only markets that actually went up, and it was up about 0.5%. Over the last 12 months, the TSX is up about 7%. Now, south of the border in the United States, after a pretty robust year last year, the Dow Jones Industrial Average dropped about 5%, actually more than 5% in January, and is down a substantial amount today. And so we're seeing some significant weakness in some of the markets that moved quite a bit last year. Over the last year, if you go from the end of January to the end of January, the Dow Jones is still up about 12%. Long-term bonds, we've talked about interest rates coming up and being concerned about being in long bonds, and therefore we don't own any long bonds. We're just in short-term bonds. They actually dropped 3%, so negative 3% over the last 12 months. So anybody in long bonds has lost money. Oil has been largely flat. Natural gas, as you know, has gone up quite a bit, especially given the cold winter. And the two areas that have been hit the hardest over the last 12 months were some of the better performing areas in January, and that would be gold and silver. So gold, which was down about 25% last 12 months, and silver 39% are both posting some pretty positive returns so far this year. And we would expect that to continue. As many people know, the areas that get hit the hardest are often the very best performing going forward. So it's a pretty choppy market. In Europe, over the last month, we've seen the European stocks drop about 3%. In Latin America, over the last month and over the last year, we've seen drops of over 30%, and that's when you convert that back into US dollar terms. And so in Asia also, we've seen drops over the last month and over the last year of around 5%. So it's a pretty interesting situation that's emerging. And as we've talked about before, the central banks around the world have been very aggressive, and at some point they've got to back off. And when they do back off, we do believe that this volatility is going to continue, and we are very well positioned to take advantage of the opportunities that are going to emerge, both using cash and also being invested in a number of industries that should do quite well in this environment. Now back to the currency changes. Over the last month, our Canadian dollar has dropped 4% against the US dollar, and over the last 12 months, it's actually dropped 10%. So people say, you know, what's the impact on my portfolio? So let me just try to give you a quick breakdown of that impact. Now, first of all, if we look at our portfolios, and I'm speaking across our whole group, so this will vary by client, we have about a third of our assets in deposit accounts, in bonds, different securities that are very, very secure and don't move too much in value, so that the volatility is very low. They just sort of chug along. And we have that because we are concerned about the markets and we want to have some firepower to take advantage of volatility. Having said that, they're 100% denominated in Canadian dollars. So as the Canadian dollar weakens, those investments, if you were to value them in US dollars, drop. Now, the majority of our assets are actually in stocks and in preferred shares. That would be about 70% of our assets. And when we look at stocks and preferred shares, I want to break that category, which is very significant, into 4 areas. And let me just explain those 4 areas briefly for you. First of all, Canadian companies that only do business in Canada, and they are not commodity companies. For example, we have 2 companies that would fall into that category, only 2. So that might be about 4% of our total assets. First Capital Realty, which is a real estate business here in Canada, and Shaw Communications, which is a media and cable company in Western Canada. So only 2 of our companies are pure Canadian businesses, and clearly as the Canadian dollar drops, those companies, they're doing well and they're making more money this year than last year, but if you were to then convert the value into US dollars, you'd see your money drop. The second category would be Canadian companies that sell their products and services not only in Canada but around the world. And certainly most of our Canadian companies would fall into that category. And so companies like TD Bank, 1/3 of its business is in the United States. Or Brookfield Infrastructure, more than 2/3 of its business is outside of Canada. And so companies like that, as our dollar drops, they bring back to Canada more wealth and higher purchasing power because they are selling into markets where their currencies have actually gone up in value, in particular the US market. So that would be the second group of companies, Canadian companies that are global in scope. The third group, which is also very significant for our clients, would be Canadian companies that are commodity businesses. So oil, gas, silver, gold. As you know, all those commodities are denominated or sold, valued, if you will, in US dollars. And so as our Canadian dollar drops, we get a pickup in the value of the revenue streams of those companies because they sell in US dollars, providing the commodity is staying flat or going up a little bit. And so that's a huge hedge. So many of our Canadian commodity companies did very well in January because of that. And so that's that third group of companies. Now, in those first 3 groups of companies, the pure Canadian companies, the Canadian companies that are global in scope, and the Canadian companies that are commodity based, that's over half of our portfolio. And approximately another half of our portfolio would be in non-Canadian global companies, like a Coca-Cola, like a Nestle, like an Oracle in the software area. And these companies are wonderful, wonderful hedges to a Canadian dollar that is weak. And therefore, as our dollar drops, those businesses go up in value as they're converted back on your statements. And so hopefully that gives you a sense of how we think about the market and what's happening when it comes to currency moves. We don't target short-term currency moves. Our focus is on buying great companies that are well run, who in most cases actually operate all around the world, and the pure Canadian dollar exposure is actually quite small. And so if you have any questions at all, please don't hesitate to contact us. And but we wanted to just update you on that. That has actually led to a more positive January than one might think. With our dollar dropping, most of our stocks actually have done fairly well. So we look forward to 2014. We'll have some more video updates on the way, and look forward to communicating with you and eventually meeting with all the clients again this year. Thank you very much. Bye now.